Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to our BCI podcast number one, titled Hitting a Double Calculations with the Ellman Calculator. Now, as many of you know, one of the critical aspects of the BCI methodology is to master all three required skills before risking even one penny of our hard-earned money. And those skills are stock selection, option selection, and position management. In this podcast, we're going to focus in on position management or exit strategies, and specifically the exit strategy called hitting a double. In this particular exit strategy, we're going to attempt to generate two income streams in the same month with the same cash investment on the same stock. And we're going to show you how you could use the multiple tab of the Ellman Calculator to monitor this trade. So that said, let's get started. As you could see here, the stock initially is an uptrending stock, and we enter the trade over here at the beginning of the contract, which is after the third Friday of the month. So the Monday or Tuesday after the third Friday of the month, we enter a trade on a stock that we have screened, and we use an option that we have made a decision on based on system criteria, like overall market assessment, personal risk tolerance, and so on. Now, what happens if the price of the stock goes down, as you can clearly see in the middle of the chart here? Well, what we could do is buy back the option if it meets our 20%, 10% guideline thresholds. So what that means is if we sold an option and the price of the stock declines, causing the option value to decline, we could buy back that option at a lower price than we generated when we first sold it. So in this particular example here, the stock was bought at $30.83 and the option was sold for 95 cents or $95 a contract. Well, 20% of that would be 19 cents. So if we could buy back the option at 19 cents or lower, then we automatically buy it back, particularly if this occurs in the first half of the contract. So you can see here the price of the stock declined, and we were able to buy back the option at 15 cents, a little bit lower than the 19-cent threshold. Now, with hitting a double, it's usually earlier in the contract, certainly the first half of the contract. We wait a couple of days or maybe even up to a week to see if the price of the stock appreciates again. Maybe there'll be some kind of recovery. If that happens, that will also pull up the value of the option. This particular case, the price of the stock did go back up, not all the way, but significantly, and we were able to resell the same option for 70 cents. So let's have a look now at the cash generation here. We generated 95 cents from the original trade, and then we had a net credit of $55 a contract by hitting a double, 70 minus 15. So $55 a contract additional over the $95, making it $150 instead of 95 for just a couple of minutes of work by being prepared with this position management technique. Now let's move this over into the world of the Ellman Calculator and see how we could use the multiple tab of the Ellman Calculator to monitor our hitting a double trades. So we started off in this hypothetical here, and I'm using this because the numbers worked out very well. This is a hypothetical trade. The previous one was a real life trade. So let's say we bought a stock at 48, sold the out of the money 50 call for $2. All right. So now we move over to the right side of the spreadsheet into the brown cells, and we see that represents a 4.2% initial time value return. We also have the possibility of another 4.2%. The price of the stock moves from 48 up to the 50 strike. Now, let's assume price declines, bringing down the value of the option to the 20% threshold. Well, 20% of $2 is 40 cents. Let's say we buy back the option at 40 cents. Well, now our net option credit goes from $2 to $160. the ROE, or the return on our option, drops from 4.2% to 3.3%. Yes, we still have our upside potential of 4.2. Now we wait a couple days, maybe up to a week, and let's say the price of the stock rebounds as it did in the previous chart. And let's say we're able to resell that same option. Now we're not going to get $2 because some time has passed, but maybe we'll get $1. So if we get $1, now our net option credit moves from 160 up to 260. And if we look at the right side of the spreadsheet, we could see that the 3.3 now moves up to 5.4. So if we take a broad view of this trade, we started at 4.2 and we ended up at 4.2 for the upside potential, and that of course remains the same. And then in terms of the return on the option, it moves from 4.2 to 5.4. So an additional 1.2%. If we could do that every month, that's 15% over and above the amount that we generated when we first sold the option. So you could see how critical using these exit strategies are. So let's just review what we learned in this podcast. Exit strategy opportunities will absolutely 100% elevate our returns to the highest possible levels, no question about it. Now, the multiple tab of the Ellman calculator can be used to monitor hitting a double calculations. All we have to do is change the net option credit based on if we bought back the option and then if we resold the option. So it will give us the specific numbers as to where we stand with these trades. Now, as far as the final results of these trades are concerned, that story hasn't been written yet because it will depend on the value of the stock at expiration. Maximum return will be if the price of the stock is at or above the strike price that we originally sold. So there you have it, our very, very first BCI podcast. I hope you enjoyed it, ladies and gentlemen, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.